Good evening, everyone, and thank you for joining us for yet another installment of the Pulse of the Market webinar. My name is Thabiso Dlamini, Marketing and Communications Manager at the Academy of Construction and Real Estate. Today, our facilitator, Kura Chihota, is hosting our distinguished speakers, Dr. Felician Komu, who is the Principal Researcher and Consultant at Majengo Estate Developers, and Pangidzai Gazi, Real Estate Investment Specialist. A kind reminder, the Africa Valuation Conference 2024 is happening from the 16th to the 18th of April at the Sky Hotel Sandton. We would like to encourage you to register for the event and join plus minus 200 built environment professionals in Johannesburg, South Africa. Without further ado, I would like to introduce Kura, who will moderate the session. Thank you. Over to you, Kura.
Thank you so much, my leader, Thabiso. Always good to be here with you and spend time with my African professionals looking at stuff going across our continent. I do not know why my video is acting up, but it's beyond me on the technology realm. But this is our second this year, and the year is already moving past. It's worrying me that we're looking at our budgets and our timelines and saying, really, Q1 is over. I mean, we're going to the long weekend for Easter now. Q1 is over. And as an individual, as businesses, it's the question time, hey, what have I done with the first 25% of the year? But be that as it may, thank you for all joining us and taking the time out to come and be with us. As always, we take a view across the continent where we get professionals who we know, love, and respect and work with to give us their individual insights. Now, the property market is like an elephant. It has got so many facets to it. And if you're holding the ear, you could say that it's wide and thin. If you're holding the trunk, you can say it's long and cylindrical. So we always moderate our views and say that somebody will have a view and an insight. We can read reports. We might fly in and visit some of these places, but the local indigenous knowledge is what we really want to tap into and share and put on the platform. So congratulations to ACA for upgrading our package. I understand this is now going out on YouTube so that people can have it as a reference point and build up a knowledge database, which is always a good thing. The more people we have talking about the sector, the healthier we get and the cross-sharing of ideas. So I'm going to kick off. I'm going to share my screen and then go through a micro presentation on Zimbabwe. Right, I'm going into slideshow mode there. So our little teapot country, our 16 million people, real estate is an asset that is not just economic, but I think is highly emotive among Zimbabweans. They can say that we fought the war for the land. And if you speak to a Zimbabwean, his highest aspiration is to have a title deed to house him and his family. And then against that backdrop, we make investments on a personal level, be it a stand, be it a house. And then on an institutional level, we find that the bedrock of institutional investing in Zimbabwe is real estate. So what are the three biggest challenges in our market? I think our cost side is a worry, where whatever it is, if it's operating a brick kiln, you can say that it should be all local currency or a fixed price, but there are uses. If you're using equipment to move stuff around, be it fuel, be it electricity, the cost of producing something like bricks is affected by the rising electricity prices. And the electricity prices are rising both because of scarcity and the price of generating it, and then a currency issue. So Zimbabwe imports power from South Africa by and large when Kariba, our hydroelectrical plant, cannot supply. So we're importing power. That's going to import inflation. And then locally, a lot of businesses will use diesel and run generators. So whatever they're producing, if it's locally produced, it's going to have a significant cost premium. What that does is push into the market product that is expensive. So we have an affordability. Incomes are not rising rapidly. We are bracing ourselves for a difficult year ahead where commodity prices, other than gold, platinum, we've seen the platinum houses retrenching staff, offering voluntary packages to say, look, we're not expecting much. So they've let go of contractors. They're reducing their permanent staff numbers. So on the mining side, our strength is being diluted there. Agriculture, we're expecting a weaker year due to El Nino. So the income available to either spend at a household level or for pension funds which receive money off payroll from employers, that's also weakening. So the affordability is a challenge. The prices of putting up units or factories or shops is rising. The input costs are rising, and then those two make affordability difficult. Our pricing remains exclusively in United States dollars. Even if you're buying land directly from a municipality, you're going to convert a US dollar price and then maybe settle it in local currency, but you will pay in US dollars. Second challenge on our side is sourcing capital. There is no shortage. I can't go 3 days without somebody sending me a proposal and saying, look, can you package this for me to take it to investors and pension funds? The capacity of the market to absorb capital is challenging. So even for accretive projects that we think we can manage development risk, we can price it well, we can move it through a marketing machine to attract the capital and the nature of that capital. So when you're talking of a shopping center, it would be optimistic to take an 18 to 24-month view on providing capital to achieve and create that asset. That 18 to 24 months is a mismatch on the needs of a pension fund with it needs to meet its contributions on a monthly basis. So tying up money in a dead, inverted commas, asset and saying, look, we've lent money and we're rolling it up over time presents a challenge. So the nature of capital, the quantum of capital, and then the tenor that capital is available on is a challenge. Then I think the last challenge, the third C, is concentration risk. Now, the concentration is our pension funds, over 50% of value is within commercial real estate. Our professionally asset management funds, the last number I saw was 55%. So when you've got the big capital investors holding that much real estate, there is the question from the regulator, the Insurance and Pension Fund Commission, who look at this and they say, look, we think there's an over-concentration in this space. So you can bring the sweetest project with the sweetest yields, but to get that past the trustees at the pension fund, they're going to look at you and want to really understand why there's an exception, why this project is so exceptional to mitigate their concentration risk. Our guests today, we're going to be talking about the prevailing interest rates in their areas and the source of capital and the nature of capital. Zimbabwe is in a hyperinflation state. I do know that our official figures talk of a blended inflation rate, which is a Zimbabwe dollar inflation rate in some ratio and measure to the United States dollars. I think it's a statistical contortion to put out that number. Few people transact in Zimbabwe dollars exclusively, and the US dollar is the lingua franca. 85% of transactions are done in United States dollars. So because of that, our funding tends to be quite expensive when you talk about a bank loan, if you can get it, and it's a big if. It's more likely to be on a personal basis where you're earning dollars because you're working for a mining house or an NGO or an embassy or a multinational that is paying you very hard dollars. If you're going to get bank funding, it's not going to be chunky. It's not the 500,000. It's not the 5, 10, 20 million dollars. It's going to be more at a household level for 200,000, 500,000 as an equity release on a property. If you can get your hands on that, you're going to pay anywhere about 15, 16, 17%. On the high end, a lot of banks are entering into, particularly on the residential cluster development side, they look at joint ventures, where a partner comes in and says, look, I've had my family home on 10,000 square meters. My dad has left it to me or wants to extract some value before he passes away. Can we do a joint venture? The feasibility is done where clusters are proposed. And then on that, you're going to see an equity split by the provider of capital, being the bank, and they partner. All of the banks have significant property departments appropriately branded, so I'm not giving away anybody's game. You've got NMB Properties that came through last year, joining CBZ Properties, joining Barcelona Investments within the ZB Banking Group. So they understand and play the game as a player in the property space. So property developments, if you're looking at clusters, you're going to look at a return of investment of 40% plus. If you're putting in equity into that, we all know on this platform that equity is the most expensive form of funding, and that's what's available. At least the landowner gets something out in terms of units on the backside, on the back end. Then in the middle, when you're looking for capital, but it's not really a capital raise mechanism, because the way our REITs are structured is that you are required to bring completed projects to a REIT and list them. We do not have the flexibility where I can raise $100 million to build whatever I need to build and then promise shareholders returns thereafter. The REIT is the legislation is written to speak to 80% of the revenues being derived from property income. So we've read that to say from rental income versus capital gain from selling units or properties, as you do in South Africa, like a Borwin or Summercon selling off plan. So the REITs are an exit mechanism, but on that exit mechanism, how is it valued? People are looking at, we just had the annual report or the annual statements put out by Tigere REIT, the first REIT to list in Zimbabwe. They've achieved pretty much what they put out in their prospectus. Looking at the number, $1.4 million US dollars net income over a valuation of 22 million, that gives us a yield of about 6.3%. So there are other instruments that are out there in the market where people are raising 6 or 12-month money at about 6, 7, 8, 9%, but it's not a regular structure, and not many people are using that. But that gives you a sense of where the money is from and the kind of shape that it comes in. It couldn't be a property discussion without talking about valuations. And we've had our wobbles here. We have the squabbles. I call them squabbles, but they're all scholarly and gentlemen between our auditors and our valuers, where the valuers will tell you the valuations as guided by the Royal Institute of Chartered Surveyors Red Book says this. And then the auditors will tell you, hey, look, by IAS, our functional currency and hyperinflation environments give us Y. So putting those two together, we found that reporting in Zimbabwe dollars gives you a very volatile picture. Our two non-REITs, but listed property companies, so loan stock companies, one is Mashonaland Holdings. You can see that the investment gains there were 117%. You can imagine how fantastic it looks and feels on the balance sheet, and then it skews the profitability because if you look on the right-hand side with First Mutual Properties in the highlighted box, the revenue from operating the business is $2 billion. But then the increase in value on properties in ZWL, because of rising rents being a function and driving, it's not a change in cap rates, it's not a change in operating environment, it's really the conversion of the US dollar back to the Zimbabwe dollar for reporting. So on a $2 billion revenue, you get a 348 investment gain. And that throws the picture into, are these property companies? Are they speculation? And then what drives those valuations? So our valuers, God bless their souls, are applying the correct methodologies to that. But in Zimbabwe dollar terms, there is an infinite write-up as the currency weakens. The currency is reportedly anywhere between 28 and 32,000 Zimbabwe dollars to $1, where last year I think we began at about 600 to 1. So that depreciation then throws and drives these kind of numbers. I mentioned Tigere REIT. They've chosen to report in US dollars, and in reporting in US dollars, their full year financials, they only showed a 1% write up in asset value. So I think as a US dollar mark to market, I would say that our values are static by that as a data point, but in Zimbabwe dollars, we seem to continue with blowing our own trumpet and applying the numbers, but the numbers not giving us real intelligence and matter. I'm glad to see that the latest financial results do not have, I've seen qualifications coming through from valuations where the auditors say we don't feel this validly represents the group's financial position, but I think we're over that right now. So that's the template that I trust our guests today are going to follow. What are the challenges? How we're doing with money, but then always there is the opportunity to share any shining lights and uplift in the matter. So that's my take from Zimbabwe. I'm by no means the only voice, or anybody out there has got comments and insights and can clarify, they're more than welcome to throw those in. But I would like to then cede the mic to my sister Pangidzai.
Hey, thanks, Kura. I'm gonna put myself on video because I don't have a fancy presentation slide deck, so you've put me under pressure, unfortunately. So everybody will have to bear with me. I do not have a presentation, but hopefully I will be able to take you through what's happening currently in South Africa on our side. Interesting to hear Kura's input from what's happening in Zimbabwe, quite a few similarities down south across the Limpopo. So it's always interesting to hear what's happening. So before I get right into it, as people may be aware, we are having our general elections coming up on the 29th of May, where we will be electing a new National Assembly and provincial legislature. So given that, there's a lot of uncertainty in the market, not knowing what's going to come up with the elections, what the new political landscape will look like. But despite that uncertainty, we are seeing a lot of realtors and valuers indicating that there is an ongoing buyer interest across all price segments and provinces in the real estate industry. So it gives us some sort of indication that market activity does remain robust despite all the apprehensions. So that also reflects some sort of resilience within the real estate sector. So we are expecting some form of positive turnaround for the property sector this year. If we then jump into speaking about the biggest challenges that property development faces. So a similarity to Kura in the Zimbabwean landscape is costs. But in addition to costs, the regulatory environment is a space that really challenges us in property development. It presents, we like to call it red tape because it feels like red tape. And I think it's one of the biggest frustrations we have in property development. I am in property development, specifically in oil and gas. So I develop service stations. So we deal with the various regulatory bodies from the Department of Mineral Resources and Energy, your local municipalities to get building plans approvals. And that is where we face one of our biggest challenges because it's something that is completely out of our control. For example, the Department of Mineral Resources and Energy, DMRE, on paper, they say they will issue you with a retail and site license if they approve the application within 90 days. That is on paper, but in reality, we are getting those licenses in at least 6 months. So that completely throws your planning out. You'll have your plan to go on site break ground May 2024, but the DMRE will take its time to issue the license, and you cannot go on the ground without that license. And that then has a ripple effect on other areas, because once your license has been issued, you've got a certain time period, a year, in which you need to commence construction. So now if we now get delays from council in terms of building plan approvals, and from our local fire department to get fire approval, then that also then has a ripple effect. So you might not be able to start your construction on time, then your licenses might lapse. So those are, in my specific industry, that's one of the biggest challenges, that regulatory environment. Another big challenge that we have is economic fluctuations, and that is typical across any market, any country. The property development sector, just by its nature, is very sensitive to economic changes. So your interest rates, inflation. Kura did mention that Zimbabwe is in hyperinflation, and unfortunately South Africa, we are seeing increasing inflation, interest rates. So that also has a big impact on property development, because obviously if you've got increasing interest rates and inflation, that at the end of the day, it affects your material cost, labor costs, and that also then can have a big impact on your viability at the end of the day. I may have projected my project to be viable today with certain returns, but in a few months' time, because of the constant interest rate hikes, my project could end up being unfeasible. That's not the right, but yeah. So that's another challenge that we face currently. And it's interesting that I think it was actually yesterday, our Monetary Policy Committee sat yesterday, and they did keep our repo rate unchanged. I think we are still on 8.25, which is still high. And it is, if I'm not mistaken, it is the highest that the repo rate has been since, what year is it? That's the highest level it's been since, what is that? Since 2009. So that's quite something. So we are facing challenges in that regard. So materials are a lot more expensive, labor is more expensive. So we are finding that we need to put in a lot more capital into our projects. A service station that we could previously develop within 18 million Rand, today we are now developing for at least 25 million. So it does have a big knock on us in that space. Kura, also you spoke about cost. So for us, it's land availability coupled with costs. So we all know Property 101, it's location, location, location. So finding that suitable land at a reasonable cost, it is becoming a challenge, particularly in my industry, because we are seeing saturation in our metro area. So your Johannesburg, particularly Johannesburg, not so much Cape Town, but in your Johannesburg, Pretoria, we are seeing significant saturation in our, we call them primary markets, our metro areas. And where you do find land, it's either you're going into Sandton and you're knocking down a couple of apartments, and your land in Sandton is significantly more expensive than your land in Randburg or in Limpopo, if we take it, if we take it chalk and cheese. So that's one of the biggest challenges we're facing. And of course, with service station developments, location becomes critical, because you need to ensure that you drive your fuel volume so that your service station is viable. So where we cannot find suitable land, it really does become a challenge. But what we are now doing is now seeking opportunities in what we call our secondary markets. So Limpopo, Mpumalanga, Northwest, and doing a lot more developments in those areas where it is viable. So it is a balancing act, because obviously the cost to service those areas, you need to take it into your feasibility calculations and see if it actually is worthwhile to move into these secondary markets. So yeah, those are three of the biggest challenges we are facing in the property development space in South Africa. But of course, like any other market, any other country, it then becomes important. Your market research becomes very important. Understanding your market demand, your current trends, and the potential growth areas, which is why I did say we're now looking at moving into secondary markets, your Limpopos, your Mpumalangas, Northwest, because we are seeing those as potential growth areas. An interesting for South Africa, Midrand has literally mushroomed up. So if you didn't have the foresight a few years ago to invest in Midrand, you're now left behind, because the development in Midrand is just phenomenal. I mean, if you just look at the past, even 3 to 5 years, the amount of development that has taken place in Midrand is exceptional. So those that had the foresight to invest in Midrand even 10 years ago, they are now reaping those rewards. So you will also see a lot of service stations that are coming up in that Midrand area, not only service stations, residential, commercial. So that's having that foresight to see potential growth areas is important. Financial planning also becomes important because of the nature of the investment that's required in property development. So you need your solid financial plans, including your funding strategies and your risk assessments. And importantly, again, to try and mitigate these challenges in the field is building the right team. Time and time again, you are faced with clients that bring in contractors that have never built a service station before, and it then ends up being time wasted, money wasted, because you condemn a site and you're not able to continue construction. You need to demolish and rebuild, and it just becomes an unnecessary time and cost for all parties involved. So building the right team is so important to just help and mitigate some of those challenges in our property development space. Then if we move on to the next element, the interest rates, I did touch on a few aspects of it just when I was speaking about the challenges. Did say that our repo rate, despite it remaining unchanged, it remains high at 8.25%. But despite that, those speculators are still optimistic about the future of the rental industry. And this is because with the high interest rate, it means that the cost of borrowing money obviously is higher. And so a lot of people won't be able to service their mortgage bonds, or won't actually even qualify for those mortgage bonds. So they then default to renting as opposed to buying. So this also now means that from a rental industry, from the rental side of it, it means that we're expecting to see a higher demand for that rental industry. Rental units are now likely to become more in demand, and also the risk of having a vacant unit is also reduced. So there is a bit of a positive outlook from the rental space. And it means that investors also have an opportunity to capitalize on the rental industry's growth and benefit, obviously, from the increased likelihood of getting reliable tenants. So also inflation, I did mention it as well. It's not hyperinflation like it is in Zimbabwe, but it is accelerating. I think we are currently probably sitting at 5.6%, which just makes it into the desired range of the 3.6%, which is the central bank's target. So that is something that we will be monitoring quite closely just to see how that plays out. Moving on to sources of capital, I won't touch on REITs and bank loans, since Kura, you did already cover those, but those are also other sources of capital that we do use in our space. An interesting one that's coming up in South Africa is what we call syndicate financing, and that's become a very popular choice. And it typically just involves a group of lenders that come together and pool resources together and offer a loan beyond what your traditional sources would provide. So the borrower, myself, will go out there, negotiate terms with potential lenders, and then we'll go through a process of legal structuring and documentation. And the people that usually come together, it can include your commercial banks, insurance companies, and private equity firms, and they will be the ones that will provide the capital in exchange for the equity in the borrower's business. So it's something that's gaining traction in South Africa. It's I haven't seen it play out too much, but it is something, like I said, it's gaining traction. So it does suit businesses that are seeking expansion, asset acquisition, or debt refinancing. Some of the advantages that it does offer are lower interest rates, longer repayment periods, and improved credit ratings that you don't typically find with your typical capital sources of funding. Another one, I think, Kura, you did also touch on private equity funds. So this is another appealing financing option that we are finding a lot of developers in South Africa going for. And it is a tool where which is managed by experienced professionals, and they invest in private companies or real estate ventures. So that's another interesting one. Another one that's also gaining popularity, funny enough, in the property development space is crowdfunding. So basically it's gaining popularity because I think it's giving South African investors the possibility of diversifying their portfolio and tapping into potential returns. It's beneficial because it offers low entry costs, access to global projects, and potential high returns, and it does provide risk mitigation strategies. Like I did say, it gives you an opportunity for portfolio diversification and tax incentives available. So those are some of the top 5 sources of capital that property developers in South Africa are making use of. And then speaking in relation to that sources of capital, there are different, I don't think Kura mentioned it in his, so I might be going above, but there are various types of deals that we then look at in the property development space. Kura, actually, you did talk about joint ventures, so I won't speak about that. In our industry, the oil and gas industry, 2 of the popular deals that we do use when we're doing these property developments, these service station developments, is development agreements. Pretty straightforward. It's where we have a project, a service station to build, and we as the oil company, we agree with the landowner to develop the service station. And obviously, we provide our specs and our standards to the property owner, and the service station is built according to these specs. So in that development agreement, there are various structures we can look at from a capital perspective, whether we go almost 50-50, 70-30, where as the oil company, we maybe invest in all the underground equipment, so your tanks, the pumps, etc., and then the property owner would be responsible for doing the superstructure, so the building, the canopy, doing all the shop fittings. But again, it's deal specific, project specific, based on the negotiations. But that's one of the deals we enter into a development agreement. Another type of deal we have is an option agreement, and that's basically where one party, the property owner, for example, grants us as the oil company the right, but not the obligation, to buy or lease the property at a predetermined price or terms within a specified period. So we typically use this kind of deal when we want to acquire a piece of land, but we have uncertain timing and conditions. Usually we call those land banks. In the oil industry, we call those land banks. We don't have certainty that we're going to build that service station today, but we do think, so it goes back to having that foresight and seeing potential growth areas. So if we see that, okay, Limpopo, I see a piece of land that does have potential to be a service station, I can then have that option agreement with the property owner that we will maybe develop this property in X number of years. So it just gives us that flexibility to negotiate terms and conditions outside of time pressures, time constraints, and not really any immediate commitment. There's also real estate partnerships, but for us in the oil and gas industry, we don't really go into real estate partnerships, but these are similar to your joint ventures. You've got your straightforward sale or purchase agreements, similar to our option agreements. We can approach property owners where we identify that actually would like to build a service station, approach a property owner and say, Mr. Property Owner, we would like to buy that property off you, and then obviously go into negotiations and enter into a sale or purchase agreement. Lease agreements are also another very common one for us in our industry, where we rather not purchase a property outright, but we will lease the property from a property owner. So again, there's different dynamics to that. We can develop the service station from the ground up in totality and give the property owner a land rental, or otherwise the property owner can say, actually, I've got capital and I'm able to invest in the development. And again, we discuss how we will go about sharing that capital cost, and the property owner will get their rental, a development rental, based on the investment on each side. So in a nutshell, those are some of the different types of deal structures that we do enter into. And then finally, in terms of the valuation post-COVID, it's been an interesting climate. I think we're still recovering quite a bit from COVID, and then coupled with rising interest rates and the inflation, it's been quite an interesting time for the real estate sector. But I think there has been quite a bit of resilience that has been shown, and of course it's dependent on the subsector of the property industry. So your office, retail, and residential have performed differently post-COVID, and that's just basically because there's different fundamental drivers behind each subsector. But in general, as I did mention previously, overall, the property sector's performance has been influenced by the interest rate trends and market dynamics. And I did allude earlier that the rental market is expected to see nice returns in the short to medium term, just because of these interest rate hikes making the cost of capital a lot more expensive. So we are likely to see your rental properties being valued a lot higher. And did say also that we are moving more to possibly more of a seller's market as opposed to a buyer's market, because the cost to service debts will be a lot higher. So you'll have a lot of people trying to offload their properties, which then has an impact then also on the value that you can actually get for your property. Because obviously if the market is flooded with an excess of properties, then that will ultimately drive down the ultimate value that you can get for your property. So looking forward to the rest of this year and how it's going to play out in the real estate space. Really looking forward to it and seeing whether these speculations actually come to fruition. Again, never a dull day in real estate. What has been speculated might not actually come to fruition, but it does look promising that these speculations, that they will actually become a reality. So looking forward to that. And from my side, that's it. Hope I covered everything that was expected of me. And thanks once again, Kura, for the opportunity. Thanks.
An absolute pleasure. Thank you for the insights. What are you looking forward to? I know it's an election year and you said you're awaiting the outcome, but what's your best case scenario? What's exciting you about 2024?
I think, again, it's just because of the uncertainty of everything that's going to come out. Like, again, I did speak about the interest rates. There's a lot of big projects that have been earmarked. And this is even just outside of oil and gas. So looking at big commercial projects, you've got super cities that have been planned for. And depending on the outcome of these elections, it will either mean that these projects go ahead or they don't. So that, I think, is what I'm looking forward to the most, just seeing if these big projects actually come to fruition, because I think it will be a game changer in the space. I mean, if we're talking about new smart cities, that is something quite exciting to look forward to. But if the elections don't go as well and you have investors pulling out of the South African real estate industry, such big projects just won't come to fruition and they won't take off from the ground. Yeah.
I understand that very well. Zimbabwe went through its election cycle last year, and many promises and ribbon cuttings and saying, oh, we're going to have the Zim Cyber City to the northwest, or pretty much north of the city. We're still waiting for that. We've got roads being graded, but to see the bulk infrastructure that a city or something that you want to call a city is going to rise above, we haven't seen that yet. So I fully understand that game. Interest rates, I was here in Johannesburg earlier, I think it was February, so it was last month, when Mike Brown of Nedbank was giving their house view on interest rates. I see that indeed the repo remained unchanged today, and today, and that was perhaps influenced by the Fed in the United States also slowing down their interest rate cuts. But the life that we started to see in the real estate investment trusts on the SA Stock Exchange seemed to be pricing in the expectation of rates coming down, and that hasn't happened yet. So we'll watch that with great interest. But overall, just as a property practitioner, do you expect 2024 to be better or worse than 2023?
I'm actually hopeful. I think 2024, I think it will be better than 2023. So even despite expected inflation and interest rate hikes, I do actually foresee it being a better year. As I did say, there are big, grand plans for the real estate industry in South Africa as a whole, but just also looking at it from the rental market, for example, there's a big boom in that space, seeing also a lot of affordable housing projects coming through as well. So it is looking promising. Driving out to areas like Mpumalanga, the development that's happening in those areas is quite, it's exciting to see. I think that those are the things that as property developers, those are things that excite us when you're driving to various areas and you're like, okay, wow, there's a lot of development that's happening in these areas. And I know also, I think it's in that Sasolburg area, there is also plans to develop that area further as some of the mining towns are being resuscitated. So there's a lot of exciting stuff that is anticipated for the real estate space in South Africa. So I think definitely, I think it is going to be a better year as opposed to 2023. And even if you look from a commercial real estate sector, people are being forced to be more creative because obviously we're still in this hybrid mode where a lot of people are now still working from home. So now you've got a lot of landlords that are faced with all this vacant office space. So what do we do? So we're now seeing a lot of exciting new innovative, out of the box kind of ideas of what to do with these office spaces. We are seeing office spaces also being converted to residential. So for me, I'm optimistic about 2024. I'm looking forward to it because there's a lot of exciting stuff that is coming up.
No, I really appreciate that. Our viewers who've tuned in to listen to the conversation, unfortunately, our third guest, Dr. Komu, is not able to join us. We were all set up and we do our checks, but the network on a day can let us down. So you've heard from myself, Kura Chihota, I'm talking about the Zimbabwean market. You've heard from my sister, Pangidzai Gazi, in Johannesburg, talking with a very strong knowledge on the fuel and gas sector, developing service stations. We want to keep the conversation going with you. We thank you for always tuning in to these monthly webinars that we do. Are there any questions from the floor? If you just want to pop up your hand or put a question in the chat box, we're still here to answer your questions. But Pangidzai, thank you for giving us such a comprehensive view and over and above it all, a sentiment that there's something for us to look forward to.
Thanks, Kura.
All right. I don't know if any of our attendees want to ask any questions. Okay. If I was on radio or TV, I've been fined because if you go silent for more than 10 seconds, it's called dead air. So I'd like to thank all of you who've taken your time to join in. Those of you who follow us on social media, be it Twitter, Facebook, LinkedIn, or the new YouTube channel, we thank you for your time and your attention. If you listen to these young TikTokers, they'll tell you, be sure to subscribe, drop a like, and share. So that's us for this evening. Thank you so much for your friendliness, your attention, and your interest. To my co-presenter, Pangidzai, thank you very much. To Thabiso behind the scenes, putting it all together, thank you very much. And for Eka, for your support, thank you so much. I wish you all a very pleasant evening further. Thank you.
Thanks, Kura. Thank you, everybody. Have a good evening.